Today, we will evaluate the impact of foreign market interventions on emerging economies. Foreign exchange markets are crucial for the global economy, facilitating trade and capital flows. However, emerging economies face significant challenges, including high exchange rate volatility and limited foreign exchange reserves. To address these challenges, many emerging economies utilize foreign exchange market intervention. By buying and selling currencies, central banks aim to stabilize the exchange rates and support economic growth. This research aims to deeply investigate the impact of foreign exchange market intervention on emerging economies. By analyzing various theories and real-world cases, we aim to provide valuable insights for policymakers on how to effectively utilize this tool while mitigating potential risks, ultimately contributing to sustainable economic development in emerging markets. Foreign market intervention are the action of central banks to achieve exchange rate stabilization or other economic objects by directly buying and selling foreign currencies, or indirectly adjust the local currency liquid in the foreign exchange market. Foreign exchange interventions' primary objects are stabilizing exchange rates to shelter economies from the instability effect of excessive currency fluctuations, maintaining competitiveness to support export-oriented industry by preventing currency appreciation, managing capital flows to mitigate the risk associated with the large capital flows or outflows. The economical effect of foreign exchange intervention are rooted in several key theories. Firstly, building upon purchasing power parity and interest rate parity, we understand that exchange rates are fundamentally driven by economic factors. However, short-term deviation from these fundamentals are inevitable due to market sentiment and speculation. Foreign exchange intervention plays a crucial role in correcting these imbalances and stabilizing the exchange rate. Secondly, the Maunder-Fleming model highlights the interconnectedness of monetary policy, fiscal policy, and exchange rate policy. In open economies with high capital mobility, central banks' intervention by influencing the money supply and capital flows can significantly impact the domestic economy. Finally, asymmetric information theory emphasizes the role of the central banks as the information provider. Intervention signals policy intentions, stabilizing expectations. The effect of intervention should be demonstrated through several channels. The portfolio balance channels. By adjusting asset allocation, the central bank influences investors' compensation for risk and thus the exchange rate. But it also has certain limitations. For signal channel, through foreign exchange market intervention and other means, central banks convey information to the market about their monetary policy intentions, thereby influencing market expectation and in turn the exchange rate. Finally, noise trading channel. This channel believes that central banks can indirectly influence exchange rate by influencing the behavior of irrational traders. Foreign exchange market intervention plays a crucial role in stabilizing emerging economies and enhancing market confidences. Its positive impact in many reflected in the following aspects. Finally, intervention effectively mitigates short-term exchange rate volatility, reducing uncertainty and boosting investor confidence. For instance, the Reserve Bank of India successfully limited rupee reappreciation during the 2008 crisis through significant dollar purchase. Secondly, intervention supports the competitiveness of export-oriented sectors by preventing excessive currency appreciation. This is crucial for economical reliant on exports, such as China, while intervention has helped maintain export competitiveness. Thirdly, intervention acts as a stabilizer during crisis, mitigating the impact of panic and preventing economic contagion. The Malaysia government efficiently stabilizing the ringgit during the 1997 Asian financial crisis through a combination of intervention and capital controls. Furthermore, intervention enhanced policy credibility and market confidence by demonstrating its resolve to maintain stabilization. The central bank gains credibility, attracting investor confidence. This was evident during the 2013 paper tantrum, when India stabilized the rupee through a combination of intervention and policy communication. Finally, intervention can provide a buffer for the development of domestic financial markets. By mitigating the systematic risk associated with large exchange rate fluctuations, intervention creates a more stable environment for the long-term growth of the domestic capital market, particularly crucial for economic with a fragile financial system. In conclusion, while the potential drawbacks, foreign exchange intervention can be a valuable tool for emerging economies to navigate volatile markets, enhance economic stability, and foster sustainable growth. Then let's my partner to introduce other parts.
Next, I will discuss something. About the negative impact of foreign market interventions, and I will focus on the cost of foreign exchange market intervention. On the one hand, exchange rates can achieve certain goals such as stabilizing price and promoting trade growth. On the other hand, it's a double-edged sword, especially the unreasonable underestimation of the local currency, which often hinders the exports of trading partners, while promoting the country's export and increase the burden on trading partners. The direct active efforts include inability to correct international balance of payments imbalance immediately. Large amount of foreign exchange reserves lost. The slow development process of the foreign exchange market. the coordination between goals of monetary policy and goal of exchange rate stability. There are three main reasons of the high cost of foreign exchange market intervention. The first, foreign exchange reserves decrease. The central bank stabilizing exchange rates by selling foreign currency and repatriating domestic currency, which reduces foreign exchange reserves. Larger declines in the foreign exchange market require more foreign currency, accelerating reserve depletion. Since most reserves are held as assets rather than cash, liquidation incurs cost and can impact global financial markets, complicating the process. Next, when the central bank buys and sells domestic and foreign currencies in the foreign exchange market, there will be many operating costs. Moreover, structural changes in the central bank's balance sheet will involve exchange rate changes caused in the future balance sheet structure regression. The last reason is the purchase and sale of currencies by the central bank in the foreign exchange market may lead to changes in the base currency. If hedging interventions are undertaken, there are costs involved. For example, an increase in the size of foreign exchange leads to an expansion of base money, and the central bank repatriates the local currencies through the issuance of bills and pays interest to the purchase of the bill. Next, I will going to describe the advantages and disadvantages of intervention in the foreign exchange market using a few samples. The first sample. Since 2024, the US dollar has excited strong passion on Asian currencies, causing sharp discrimination in many countries. Japan, and the world's fourth largest economy, has been most affected. In contrast, China's currency has remained relatively strong, and India's rupee has shown remarkable resilience, whereas in May 2023, $1 could be changed for rupee 2082. Now it can only be exchanged for rupee 93.5, a description of only 1.82%. So the government of India has taken the following measures: selling US dollars, raising interest rates, introducing foreign exchange swaps. These measures effectively eased foreign market panic and prevented a vicious circle of capital outflows. Let's take a look at the failed foreign exchange market intervention in Thailand and Argentina. The Bank of Thailand intervened foreign exchange market several times to balance the exchange rate stability of the Thai baht, where the Asian financial crisis. However, due to the collapse of market confidence, the Thai baht had to give up the fixed exchange rate, while leading to a more serious economic crisis. The Argentine economy has long plagued by high inflation, which in the late 1980s exceeded to 20,000%. Argentina has implemented several economic stabilization programs based on fixed exchange rates, but almost all of them have ended in the outbreak of financial and currency crisis. There are my three summarized policy recommendations. The first one, diversify and integrate interventions measures, establish a foreign exchange stabilization fund, adjust reserve requirements, interest rates, and control credit expansion in high-risk industries and regions. Second, increase exchange rate flexibility, promoting exchange rate marketization, expanding the floating range of currencies in emerging markets, minimizing interventions and allowing exchange rates to reflect real market supply and demand can better stabilize international payment balance. The last is optimizing the structure of foreign exchange reserves. Focus on optimizing the currency reserve structure of foreign exchange market, the structure of investment and financial assets. The allocation ratio of global assets should be appropriately increased. So, conclusion, exchange rate intervention should not be a routine tool for addressing imbalance. Most global interventions are short-term measures to prevent exchange rate overshooting. Over-regulation can cause deviations from economic fundamentals, trigger disorderly cross-border capital flows, and negatively impact financial markets, price, employment, and growth. Investors must closely monitor global economic changes and adapt their strategies to navigate the volatile foreign exchange market and the impact of the global economy on exchange rates evolves. Understanding these factors and adjusting accordingly will be crucial for investors' success. The next two pages is our paper reference. The above is for extent of our research. Thank you.